Okay, ladies and gentlemen, once again, welcome. My name is Mark McGowan, and it's a pleasure to be your host for today. On behalf of the South African Chamber of Commerce Singapore, I would like to welcome all of our members and guests who are participating in this webinar today, from South Africa to as far afield as Southeast Asia. Welcome. We hope that we will give you something to think about today. We've got a good lineup for you. Today we're going to look at the South African budget from two perspectives. We will first actually look at it from an economic perspective, and we will then also look at it from more from a personal tax perspective, from the implications to expatriates, and what the implications will be from a tax perspective and from a financial immigration basis. And we're very fortunate today to be joined by two of our members. Firstly, we are joined by St. James's Place, who are our platinum sponsor. And we are also joined by our newest corporate member, being Absa Corporate and Investment Bank. It's great to have Absa on board. I think everybody is very well aware of Absa's presence in South Africa and definitely on the African continent. But we're looking forward today to actually hear what Absa sees as their vision for Southeast Asia and their presence in the region. So without any further ado, I would like to hand over to Pramesh Naidu, who is the Managing Director and the head of Middle East and Africa Corridor at Absa, to say a few words and to give us some insight into Absa's presence in the region. Prem, over to you.
Okay, thank you very much, Mark. And I guess it's good afternoon to all of the participants on the call today. I think I just want to spend a few minutes to tell you a little bit about Absa, some of the trends that we are seeing, and then also some of the opportunities before I hand over to Jeff. And I think maybe just a bit of a correction. So as much as I head up what we call the MEA corridor, it's actually the Middle East and Asia corridor. And it's interesting that not many people are aware that Absa has quite a specific focus on Middle East and Asia. And just a few points on Absa itself. We're one of the largest regional banks in Africa. We're present in 10 markets, in addition to having rep offices in Namibia and Nigeria. In addition, we also have offices in New York and London, and that's to give us the international connectivity. We offer a full suite of corporate and investment banking solutions, and some of the recent achievements that we are particularly proud of is, and related to the Asia region, is having recently advised an Asian client on the sale of its interest in a power project in South Africa. We've also been involved in a number of IPOs in recent years, and have also assisted a number of companies, given the impact of COVID, to access the debt and equity capital markets, and certainly to assist them to strengthen their balance sheets. Absa has also invested quite significantly in its platforms to provide a world-class treasury, trade finance, and cash management solution on the African continent. And a lot of that development has actually gone towards the needs and the requirements of some of our multinational clients. And some of the trends that we have seen, which I think may be of interest to the audience today, is that there's been a lot of talk of the South African Economic Reconstruction and Recovery Plan, which seeks to commit 800 billion rand towards infrastructure investment. Within this, there's an opportunity for private capital. Only 2% of this infrastructure commitment is actually related to public-private partnerships. So there's certainly a lot more that can be done to leverage the PPP model to further development of infrastructure in South Africa. And some of the opportunities that we're seeing are actually quite interesting. For example, the government has chosen a PPP model as a basis to upgrade one of the country's busiest border posts, and that is the Bedbridge border between South Africa and Zimbabwe. That's a $300 million investment. And as I say, that's been done on a PPP partnership basis. Last year, the government has gazetted about 50 projects across water and sanitation, energy, transport and logistics, digital infrastructure, agriculture and agro-processing. And Absa has been quite active in each of these areas and can pride itself as being one of the largest funders in each of the sectors that have been represented by these projects. In particular, we maintain a lead banker position to the agri sector in South Africa, both across primary and secondary agri. And there's a growing focus from an Absa perspective on soft commodity trading, which actually has a very strong base out of Singapore. Absa has funded well over 2 billion rands equivalent of telco and digital infrastructure in recent years, and also holds a market-leading position in terms of funding 33 renewable energy projects, which represents about 46% of the total megawatts that have been rolled out under the government's independent power procurement program. I think many respondents who are familiar with South Africa will know that Ford recently announced $1 billion investment. We've seen similar investments in mining, petroleum refining, food and agro-processing, ICT, and as I said, renewable energy. And I think renewable energy offers some very exciting possibilities, specifically in terms of the related industries around the renewable energy infrastructure drive. In particular, lithium battery production is something that offers quite exciting possibilities given the fact that lithium is easily available in South Africa. In terms of the opportunities that we see looking forward, the African Continental Free Trade Area Agreement offers a single market and a common trade area which covers 54 countries, 1.3 billion people, and more than $2 trillion in GDP. The interregional trade opens a number of opportunities towards multinational companies who wish to invest. And in terms of their investment, South Africa offers a number of advantages in terms of being one of the largest economies on the continent, certainly the most industrialized country, and extremely well-developed transport infrastructure. And this places it at an advantage to leverage the benefits available under the African Continental Free Trade Area Agreement. South Africa is also in the final stages of acceding to the Association of Southeast Asian Nations Treaty of Amity. And this will allow it to deepen its engagement, cooperation, and economic ties with the ASEAN countries. Singapore has certainly emerged as the largest investor in Africa among Southeast Asian countries. And it demonstrates the growing ties between the two regions. South Africa is actually one of the largest beneficiaries of this investment. Hence, Absa's very keen interest to develop our business relationships with Singaporean-based companies. So with that, let me hand you over to Absa CIB's Head of Research, Mr. Jeff Gable, who will take us through the South African government's unenviable task of trying to balance its fiscal challenges with the need to prioritize a developmental agenda in order to ease poverty and unemployment in South Africa. Jeff, across to you. Thank you.
Pamish, thank you for that. And earlier, Mark, thank you for the introduction. And broadly, thanks to everyone for this opportunity to reach out and discuss these very interesting topics with you. We are kind of plus minus 1 year into this most astonishing and difficult economic time, not just here in South Africa, but globally. We're about a week and a half past the announcement of South Africa's most recent budget. And so let me talk through those two topics and sort of link them together, and that will help set out sort of the stage or the environment that we sort of find ourselves in right now. So as all economists, there's going to be a few slides here. I think less than most. There won't be impossible to read fonts, etc. Let me see where we get on here. So the first thing I want to do is really sort of set out this environment that we find ourselves in a post-COVID world. And so the graphic in front of you right now is sort of the Google mobility data. It's an astonishing data set, sort of very few of us knew existed about a year ago, and it tracks kind of mobile devices, phones and tablets. It sort of knows where shopping malls are and hospitals and places of worship. It can sort of work out, it can reverse engineer. If you spend sort of late evening till sort of early morning in the same place 7 days a week, it figures it's probably your house. And it can work out your place of work if you're there during the day, Monday to Friday, regularly, etc. And so what you see in the graphic is this sort of pattern that we're on here in terms of South Africa little more than a year ago, a little less than a year ago, late March of last year, going into one of the world's most stringent lockdowns. And in that space, then different parts of the economy starting to recover. So the top line, so the gold, orange colored line here is supermarkets and pharmacies. And so very much stuff that is not discretionary spend. And so you can see by the end of last year, sort of the pattern had returned almost to normal in terms of spending habits, probably bigger baskets and fewer absolute visits. But that's a part of the economy that had managed to recover fairly quickly. Again, it's not a lot of discretionary spend in that space. Contrast that with the lowest line on this graph, which is around transit. So that's not just the airports that are empty and the trains that have very few people on them, but that's all the people like myself that are working from home right now. That's the social distancing and other forms of public transport. And so that's showing that on that metric, at least, even as many of the social distancing restrictions and various forms of economic lockdown are lifted, that we are still a very long way away right now from where we were before. And whether it be a discussion about South Africa or whether somewhere else in the world, of course, it's very much clever minds having a think about how different parts of the economy are likely to recover from the first instance of COVID restrictions, but also where these changes may be a little bit more permanent. What's certainly clear for South Africa, though, and probably true for many other parts of the world, is just how sizable the impact of this economic contraction was last year. And so in that space, then, what we have is that as the restrictions came and sort of locked the economy down, we had the red line on the graphic to your left is sort of thinking about the end of 2019. So the last bit of really pre-COVID data, the last bit of 2019 being set to zero for the economy in this graphic, and you see the very sharp plummeting of activity, almost 1/5 of the economy coming to an absolute standstill, and then sort of this V-shaped path, right? This idea that the economy as a whole, as restrictions ease, we sort of snap back fairly quickly. And I wanted to highlight sort of some context around this, because the nature of this shock, and I suppose this is true beyond South Africa as well, the nature of this shock is so different and so much larger than what we've seen before. It's easy to get caught in the details, growth rates that were big and minus, and then very big and positive, and sort of missing the broader perspective here. So as I say, that zero line is the size of the economy at the end of 2019. In the early parts of last year, when we thought about our forecast for South Africa, that's sort of this orangey yellow line was a country that had been growing for the last half decade, only 1 or 1.5% a year, less than the pace of population, certainly less than productivity growth. So you had an environment where very few jobs were being created, where social strain was already sort of rising in significant ways. Where public finance, we're going to spend a bunch of time on that in a moment, where public finance was under real pressure. Now that is a very aspirational line for the economy today, but it was something that we were quite worried about a year earlier. The red line is sort of our best forecast going forward, and if we were to extend this graph 2 or 3 years out, you would see that it's only towards the very end of 2023, whereas Absa research, we think that the economy will regain sort of the level of output that it was before this downturn. And then the dotted line, I think, is also quite useful and interesting. It's the global financial crisis. So different parts of the world felt the GFC in different ways. Here on the African continent, certainly here in South Africa, our impact was actually pretty light. As a headline measure, it was the country's first recession in the democratic era, going back at that point more than 20 years. But the recession really only lasted 5 quarters. Not if you think in each of those quarters things were getting worse, but the time it took you to go through the dip, come out the other side, and find an economy already bigger than it was before the downturn, barely more than a year. Well, this time we're saying it's going to take sort of 3 or 4 years. And in that space, of course, as well, it's not just about the overall economic number, it's about how different sectors are being impacted in that space. So the table in front of you right now reflects just 2020, but to the extent that those sectors hardest hit in 2020 are, in our mind at least, those sectors that will also recover the most slowly going forward, it's still very instructive. In South Africa last year, the only meaningful sectors in the economy that actually showed economic growth, one was agriculture, very little impacted by COVID, very much impacted by its own cycle, which are growing seasons. 2020 was the first great growing season we had in South Africa after a number of very difficult years. Happily, indications are that 2021 looks similarly good. So that's a very strong sector in South Africa right now. Telecoms, as sort of referenced by this discussion we're having here today, instead of being face-to-face, they've sort of had, I guess a good crisis would be the language in that space. But all the other meaningful parts of South Africa are significantly smaller today than they were at the beginning of this. And for some of them, certainly the hospitality industry, whether you're facing off against local conferences and weddings and local tourism, or whether you're looking for the planes full of global tourists coming from overseas, that's a sector that's going to recover only over very many years. Construction sector being hit by decline in certainty, by firms and households sort of being a little bit more cautious in their spending. Manufacturing and mining also struggling in that space. And so it's not just about the direction for the overall economy here, but it's also very much about how that's going to be witnessed across the different sectors that matter. But again, the broader message here is that this is a downturn unlike any other. We think about South Africa's economic history going back about a century, right? We go back about a century, there's only been 5 or 6 periods over that century where the economy has shrunk, despite all of the challenges that South Africa has faced at different periods. Our expectation is it's 3 or 4 years, not to get back to where we would hope we would be in 3 or 4 years, but just to get back to where we were pre-COVID in South Africa. So there are real and meaningful challenges here. And that's the context that National Treasury, that Finance Minister Mbweni, his cabinet ministers and President Ramaphosa must sit down and sort of consider when they're thinking about formulating sort of the budget process for South Africa. Already, we've been very much focused here on sort of the country's debt to GDP, right? Many countries witnessed their fiscal deficits skyrocketing in 2020 as revenues fell and the needs for public spending rose significantly. Major international financial institutions like the IMF are sort of giving countries a signal saying, don't worry too much about deficits right now. Don't worry too much about debt. The most important thing we must do is support economies, and we'll make a plan around getting on top of public finance a little bit later. That probably makes an awful lot of sense for countries like Singapore, where interest rates are very low and the cost to sort of borrow today to help support an economy is very modest. It makes sense in much of Europe. It makes sense in the United States. It's less clear in some other parts of the emerging market space. And so the graphic that's on the left hand side right now, the black line is debt to GDP for the government in South Africa. And we go back about 15 years ago, that was about a quarter. South Africa actually had 2 years in which it ran fiscal surpluses. Didn't mean that South Africa had all the jobs it needed. It didn't mean that it didn't have this horrific sort of social and economic hangover from apartheid days. But it did mean in that space that government was collecting more money from the economy every year that they were able to spend, even as spending at that time was seen as generous. Well, over the last decade and a half, even before you get to the pandemic impacted figures, you'll see that debt to GDP rose very dramatically from about 25% of GDP back in 2007-8, already pre-pandemic, to getting to 60%, and now at the end of the financial year, fiscal year that's just ended, probably about 80% and on its way to 90%. So a dramatic increase in that space. Now that's true for many countries around the world. Why it matters so much in South Africa and why I want to discuss public finance through this lens is because of the gold line, or what the gold line represents on this graphic. And that's looking at not how much debt you have, but how much it costs to service it. And here I'm defining servicing as not, paying the debt back. That's not how governments work typically, right? That's just on the interest rate component. So for every rand of taxes you collect from the economy, whether it's directly through corporate tax, or whether it's excise and duties, or whether it's personal income tax or VAT, each of those rands that you collect is not all that easy. And then you want to go and spend that building sort of a fairer society, building a society that is more competitive, doing all the things that government can do to help ensure that the future for all the citizens is better than the past. Well, in this space then, you've already seen in South Africa go from 6 or 7 cents out of every rand collected in tax just to pay the interest rate costs to more than 1 out of every 5 rands collected just to pay interest rate costs. And so that's sort of the evidence that now you've got a public finance problem. Probably more so than interest rates, return interest rates rising, probably more so than when the credit rating agencies downgrade you. This is where the rubber hits the road. Taxpayers, voters, don't reward you for paying interest on stuff in the past. They want new programs, they want new services today. And what's happening is that the space for that of the tax you collect is getting smaller and smaller in that space. If we might just move forward one, Mark, I apologize. Oh, there we go. It's not a whole slide, but we're just going to step forward a little bit here. So then the question becomes in South Africa, as you're sitting down the budget, where should we focus? Do we just need to raise more tax, right? Because everywhere, one of the stories that we've had during the pandemic is that tax receipts have cratered. Businesses have sort of stopped. Many people have lost their jobs. So maybe what we just need to do is grit our teeth through this as the economy starts to recover, taxes will recover, and we can deal with deficits at that point. And that's probably the right narrative for a lot of countries, but through the eyes of National Treasury in South Africa, and certainly through my eyes, I'm not sure that was the right answer here and now. Graphic in front of you, the top band shows expenditure of government, not on interest, but on everything else over the last sort of decade and a half. And the red line are revenues. So compared to other emerging markets, and the units here as a percent of the size of the economy, South Africa collecting 24, 25, almost 26% of GDP in tax revenues puts it amongst the very highest in the emerging market environment. And it reflects a sophisticated, industrialized economy as compared with many REM peers. Challenge we had, in the aftermath of the global financial crisis, we ramped up government spending and never had it come back. And so the view here from Treasury, the view here from orthodox economists is that South Africa doesn't necessarily have a tax problem. South Africa instead has an expenditure problem. We're simply spending more than we can afford. Now in that space then, right, a couple observations from government. One is that despite spending all this extra money, economic growth started sort of the 2010s at 2 or 3%, slipped into the 2%, slipped into the 1.5%, slipped down to 1% plus minus before the global, before the COVID pandemic. So something already is broken in the growth model in South Africa. And we see that tax collection was already near record highs. So the deficits weren't necessarily being generated because we weren't collecting enough tax. It's because we're spending too much, and that spending didn't seem to be generating much additional economic growth. In economist speak, that talks about sort of fiscal multipliers. The idea that for good government spending, you spend 1 rand, right? And for that 1 rand, you generate several rands worth of economic activity in the economy. Well, there's been plenty of evidence in South Africa recently that the opposite has been true. That for each 1 rand you spend, you're getting less than 1 rand back. In some cases, it might even be negative. And the risk in all that, of course, is that as you let these trends continue, you crowd out other forms of spending. Interest service becomes a larger and larger portion of what you have to do every year. And in the case of South Africa, it's not just interest costs. We've also been spending an awful lot on public sector employment. And so that's one of the key parts of the budget that was presented in late February. So one of the key parts is just what on earth we do around sort of that public sector wage growth. And so the graphic on the right-hand side here is using data from the OECD, and it highlights that in 2019, so before COVID went and impacted economies, only Denmark and Norway were spending more on the public sector wage bill than South Africa was, which is quite astonishing. If you think about the social contract that Southern and Northern European countries have with their populations, that's probably a very different social contract than you would expect in sort of a middle income emerging market as we are here in South Africa. So there's plenty of evidence here that on the expenditure side, we've got something that's gone wrong on public sector wages. And it reflects that for last more than a decade, each and every year, public sector employment has been quite robust, more people. And each and every year, public sector wage growth has been significantly above inflation. So over the year that we're just finishing, Treasury's shocked not only public sector employees, but markets as well. In the middle of last year, they said, we're not going to honor the wage deal. You're meant to be receiving a 5 or 6% wage increase this year. Actually, it's zero. We simply don't have the money. And as government is currently sat down with the public sector unions to negotiate a 1, 2, or 3-year wage deal to take us through the medium term right now, government's starting offer is that we don't have any money. There will not be any cost of living adjustments. Against that, the unions themselves have said, well, that's not how we see it. If we want inflation plus 3 or 4%, but there are very difficult, very brave decisions being taken right now. And it's not at all obvious how this will work itself out. It's not just public sector workers that are expected to take the brunt of this adjustment in the budget. It's also around what we call in South Africa the social wage. So we have, as we sit here today in South Africa, more than 18 million South Africans in a country of less than 60 million people. More than 18 million South Africans receiving some form of direct government support. Some it's a public pension. For a few people, it's unemployment insurance. Much of it is around providing direct support to households if they have children under the age of 18 in them. And for the first time that I can remember in the budget, whilst the nominal payments, the rand amount you get per month for each child in the household goes up, it goes up by significantly less than inflation. So this really is a very aggressive budget saying we simply do not have the money to spend on the things that we have spent in the past. Against that, and maybe most interestingly, it isn't that they've had to continue to cut revenue projections. In fact, when the finance minister addressed Parliament a week and a half ago, he said in the fiscal year that's ending, we think actually, compared to our most fearful forecasts, there's about 100 billion rand that's come in that we hadn't anticipated, largely from the mining sector. Over the next 3 years, it's almost 300 billion rand in expenditures that we had feared wouldn't be there, and now we think that they are. What's interesting in that space, though, is that money isn't being put aside for increasing social grants. It's not being put aside for the fight with the unions on just what an appropriate pay deal is going to be like. The vast majority of that, almost 280 billion rand, is being used to reduce the deficits directly. Broadly on the tax side, last October when Treasury was speaking to us, the message was, we're in a very difficult position. We're going to have to raise taxes. We're going to have to bring in 30, 40 billion rand in extra money a year, even in a very weak economy. It's the only way we can make the book square. Well, in fact, when Treasury discussed the budget a week and a half ago, those tax hikes were set aside. Okay? We don't need to raise taxes in that way. As a very big and positive headline surprise, the country cut its corporate income tax rate for the first time in many years, from 28% to 27%. I know that that's fairly small, but the direction, I think, is really important and certainly stands at odds with what we see in some other parts of the world. Of course, you have seen the news from the UK over the last day or two, where the corporate income tax rate rises significantly. And there's even been some tax relief for employees and others, not reduction of the absolute tax rates, but an under-indexing of where it goes. So a very brave budget in this space, a bunch of extra money in some sense, revenues doing not quite as poorly as they had feared, that money not being put towards the sorts of spending that we have been doing over the last decade or so. Instead, saying we're going to have very difficult discussions around social grants, very difficult discussions around public sector wages. And for taxpayers themselves, whether they be corporates or households, we're actually going to look to provide a little bit of relief. So very, very significant. There's also some reprioritization of spending. So it's not the case that everyone that needed money from the budget was told, forget it, We just don't have it right now. There's a little bit more money for some of the state-owned companies, land bank in particular. There's more money for the revenue service in getting them recapacitated, getting them technology they need to go out and look at the economy as they find it and make sure that people who owe tax are collecting it. They're collecting it from them rather than trying to extract more tax through new taxes from all of us that are compliant. There's money, of course, not just in South Africa, but everywhere in the world for the vaccine rollout. President's Job Initiative gets about 11 billion rand, and that's about making sort of small, irregular employment, particularly in rural areas in South Africa where there's very little other labor income whatsoever. And then small extension of some of the social relief for COVID. But perhaps the more interesting bits relevant to this audience is what the budget says about infrastructure. So what it doesn't do is announce huge new monies for infrastructure. The envelope simply doesn't exist right now in order to announce those kinds of programs. But if you compare what's happening in the health service in wages, in the education service in wages, in the security services in wages, and elsewhere, and if you think about the pressure on the budget from ever rising interest expenses, I do think it's a really strong and positive message that non-compensation, non-interest rate spending at least continues to grow a little bit in real terms in the budget going forward. There's almost 800 billion rand in the budget over the next 3 years to focus on energy, to focus on water, to focus on transport and sort of health, education, and housing. Beyond that, and because a lot of that is very sort of government focused, the 100 billion rand towards sort of the infrastructure fund is a way to sort of encourage this blended finance model, private sector participation, the DFIs and others. And they're sort of the projects that are really being highlighted over the next 1 or 2 or 3 years is around sort of the provision of better student housing. It's around South Africa Connect, which is sort of the digital economy and ensuring that different parts of the public infrastructure have appropriate access to the right communication technologies. It's around water infrastructure at the municipal level. And maybe most interestingly, at this time where there's a frustration on economy being very difficult position, social pressures being very large, sort of voices from some areas saying, listen, we just need to and somehow force people to invest in infrastructure. There's a discussion in South Africa around prescribed assets that would, in the most aggressive version of that, tell pension funds that they must provide a certain portion of their money to infrastructure assets. Instead, the language in the budget is we're going to look at making changes to the pension regulation, but all of that is going to make it easier. It's going to make it to better cater for infrastructure investment, not force it, but provide a wrapper that makes it easier for those funds that have an interest in long-term projects to be able to put them on their books. And so that's really very positive. And now we're on sort of my last slide here, which is just sort of a summing of this whole thing and what I guess the next steps are going forward. So I think I've used the word brave a couple of times already. I really think that the budget that we saw in any year is politically quite brave from Treasury. And given the economic challenges we're in currently, particularly brave. And that raises the natural question, I'm afraid to say, of sort of, will others follow? Who are the others, right? The others are the cabinet colleagues of National Treasury. Others are other economic models that exist within this government. It's a tripartite partners, not just sort of those from sort of the conservative right or business-friendly community in South Africa, but the voices from elsewhere on the left-right spectrum. So what's absolutely critical in that space, it's going to be several months, but the outcome of the collective bargaining with public sector employees is absolutely critical. If you budget for nothing and somehow you settle at 5 or 6% per year wage increases from here, the budget's not worth the paper that it's written on. It's going to be very difficult for some of the special social spending that was announced in the middle part of last year to try to protect some of South Africans' most vulnerable citizens from sort of the COVID-related impacts on the economy. Pulling some of those support mechanisms out going to be very, very difficult and fraught. And both of these things, together with this lower than inflation index social grant uplifts, all of those things together happen at a time when this government will be competing in municipal elections sometime in the third or fourth quarter of this year. So that is the very definition of being politically brave. Beyond that component, interest costs, right? Interest rate costs are very important in this model. South Africa is fortunate enough that it has a lot of very long-term financing already baked in, but we also have one of the steepest yield curves in the world, and deficits, though coming down, remain very substantial. And so you are continuing to finance with expensive money, replacing stuff that was a little bit less expensive. And then, of course, just what's going to happen with regard to the state-owned companies. And not just there, but other contingent liabilities. So it's South African Airways, it's Airports Company South Africa, it's Denel, of course, it's Eskom on the state-owned company side as being the largest potential challenges in that space. But the government also has very significant other contingent liabilities, the road accident fund and others. So there's an awful lot of strain sat here, potentially about to fall onto the formal central government balance sheet. And beyond all of this, and the very last point that I make, is that it's a brave budget. I think it's well targeted. We'll see how much support it brings from both within broader government and outside. But there is no replacement here in South Africa for an economy that's growing more robustly. And public finance can help contribute to that. Monetary policy can help contribute to that. Government, through its policies, can help contribute to that. All of that needs to be running correctly. But in the end, we need an environment where households are more confident, where business is more confident, more investments are made. Because even in a pre-COVID environment, the country was growing barely 1%. And so perhaps the graphs around debt and debt service weren't quite as steep, but the direction was already very wrong. And so the real success that will be generated for South Africa over the next few years is around those investments, improving the trend growth rate of the country and moving us into sort of a higher trajectory. Let me leave my comments there and hand over to, I guess, back to you, Mark, and then to Michael.
Excellent. Thank you, Jeff. Thank you for a very, very informative presentation. I think I must agree with you wholeheartedly. A very, very brave budget. And I think now we all have to sit back and actually see whether the rest of the government has the political will to actually see this through. Because no doubt that will be absolutely key. Jeff, don't run away. We've had some good questions coming through for you, which we hope will tax your brain towards the end of the session. But before that, it gives me a great pleasure to introduce Michael Booth, the Associate Partner at St. James's Place, Asia. For those of you who have heard Michael speak before, you will know just how passionate Michael is about South African taxes and financial immigration and for foreign employment income tax on South African residents. It's something that Michael speaks very passionately about on a regular basis. And Michael, over to you to give us your take on how this has been affected by the budget.
Sure. Mark, thank you very much for the kind introduction. Good afternoon or evening to everyone in Singapore, and I hope you're enjoying your lunch over in South Africa, and thank you for joining us today. So just in terms of a brief introduction, yes, those are two of the points that I will be covering. But I think what's important to state is what I'm going to really be speaking about today is going to be focused really on primarily from an expat's point of view. So people who have gone out of South Africa and living and working, how is this budget going to affect you? And just drill into that and keep it as short and sweet as possible. I'll keep this very informative. So without further ado, I'm just going to go off to the next slide. There you go. All right, so the areas that I'd like to focus on here today is something that came out in the actual budget speech more than a year ago already, worldwide income tax based on residency. I just want to touch on residency just very briefly. And then that will bring me nicely into the phasing out of financial immigration. And what does this mean to the withdrawing of your retirement funds as a non-resident? So if you were to pull your pension funds out of South Africa as a non-resident, how do you do that? And then lastly, just as Jeff had touched on previously, a little bit more about Regulation 28 and what they've changed as an amendment to increase investment into infrastructure. So just a little bit about me. My background, I studied in Port Elizabeth and also in Bloemfontein. I have a Bachelor of Commerce in Financial Planning and also a graduate diploma in financial planning law from University of Free State. St. James's Place is a multinational wealth management firm. We have offices in London, Singapore, Hong Kong, and Shanghai. We manage in excess of 235 billion Singapore dollars, which is the equivalent of about 130 billion pounds sterling. We have 760,000 clients across the globe who entrust us with the management of their money. So let's get into it. Right, so in terms of tax residency, South Africa has a residence-based tax system. What this means is if you are considered to be a tax resident, they will tax you on your worldwide income. And there's two ways that they derive the tax residency. First of all is what they call ordinarily resident. And second of all is the physical presence test. So just in terms of that, just getting a message through here, just give me a sec. Right, so in terms of this, we have the ordinarily resident and physical presence. Now, I want you to just quickly touch on these, and once I've been through it, you'll understand why this is important. So, right, there's two ways that they derive your physical presence or ordinarily residence. How is this derived? Just a slight delay in my slides here, sorry about that. Right, so I'm sure that as expats in outside of South Africa, or even people living within South Africa, you would have heard of the 183-day rule, which essentially means that you have to be out of the country for 183 days to be considered not physically present within the year. Further to this, you have to be physically present in South Africa for 91 days in aggregate during the year of assessment, and then 91 days for 5 years consecutively. And essentially that would then deem you to be physical present in South Africa, making you a South African tax resident, meaning that they will be able to tax you on your worldwide income. Now, that one's quite easy to understand. If you are in South Africa for a period of time, they will deem you as tax resident and they will tax you on worldwide income. Simple enough. Further to this is what they call ordinarily resident. So in short, this means it is the place that you return to from your wanderings. You leave the country, and eventually if you return to South Africa from your wanderings, this is direct from case law from back in the day, 1930s, then it is considered to be your place of a habitual abode, and it is the center of your vital interests. So that just sounds like a bunch of heebie-jeebie nonsense. What does it actually mean to be a place of habitual abode? And how do they establish where your vital interests lie? So this is not limited, but this is some of the things that they consider when establishing if you're a South African tax resident ordinarily. So essentially, if they can prove that you have the intention to return to South Africa at any stage, you would be deemed to be tax resident for the entirety of the time that you are abroad. Now, it is the place they can prove that you have the most fixed and settled place of residence, where you have the place of business, your economic interests are there. They even go as far as to say that the person's nationality. So if you hold a South African passport, they can use that as reason to prove that you are an ordinary resident. And And it goes on. And this list is not exhaustive. This is just merely a guideline. So these are the things that the South African Revenue Service would use to basically deem that you are ordinarily resident. So now that we've been through that, you have physical presence, you have ordinarily resident. These are deemed to establish if you're a South African tax resident. Now, why is this important? This is important because as of the last year, 2020, the year of assessment, you are now being taxed on your foreign employment income. So any income that you earn in excess of 125 million Rand can be taxed by the South African government. Now, this income is derived from your foreign employment. So essentially, anything in excess of this amount will be taxed in South Africa. Do not worry though, thanks to double tax agreements with most countries around the world, you can be protected against this if you are found to be South African tax resident. Now, the easiest way not to be taxed on your foreign employment income is, let it load, becoming non-resident. So how do you become non-resident for South African tax purposes? Upon leaving South Africa, when you take up employment abroad or you decide to leave the country, you are obligated to let the authorities know that you have left the country through a process of tax migration. Now, this is an area of the 2021 budget that has changed. And how has it changed? Right. So tax migration simply means that you have become a non-resident South African citizen for tax purposes. This is the procedure by which you inform SARS that you have left the country and you're a non-tax resident. This was previously achieved by using financial immigration and working with the South African Reserve Bank. As of this year, as of the 28th of February, that's now gone. So financial immigration has been phased out. And now the only way that you can do it is by breaking your tax residence formally with SARS and or becoming an ordinary resident in another country, which has a double agreement, tax agreement with South Africa. So in terms of that, people who are in Singapore can apply for a certificate of residence from the Internal Revenue Services of Singapore. Easy enough to find the form. And essentially, if you are still found to be tax resident, and if the tax man was ever to come after you from South Africa, you can use this certificate of residence to say, I pay taxes in Singapore. This is the amount of taxes I pay. We have a double taxation agreement. And therefore, the taxes I've paid in Singapore should be offset against the taxable income that I have in South Africa. Moral of the story, thanks to having a good double tax agreement, most people would be in the clear. However, if you are earning a very large amount of money, you would then still be paying taxes in both countries. So obviously, if you can become non-resident, that would be in your best interest. So what does this actually mean? If you become non-resident, you do not have to declare your worldwide earnings, but you have to declare your earnings on your income derived out of South Africa. For example, I own a property in South Africa. I need to declare the rental income to SARS for that, but I don't have to tell them how much I earn from my foreign employment while living abroad. So essentially, the big thing that's changed here, financial immigration is now phased out. So when you do this whole tax migration story and you've now informed them that you are non-resident, an exit tax is payable to the South African Revenue Service in the way of capital gains tax. Now, once you cease not to be resident, so you cease being resident, there's a deemed disposal on your worldwide income, on your worldwide assets, and then you'll pay capital gains on this. Some things are excluded on this, including your immovable property, such as your home in South Africa, shares in permanent establishments, and certain equity instruments. So now you leave the country, you inform SARS that you are no longer a South African tax resident so that they do not tax you on your foreign employment income. Great. But upon doing so, you will have to pay a capital gains tax or exit tax on your existing worldwide assets. So you have to really weigh up if that's going to be worth it for you. And I would advise that you take up formal tax advice when doing this. So what does the phasing out of financial immigration really mean to us as foreigners sitting outside of the country already? Right? So now that foreign financial immigration is gone, the biggest impact this has is on the withdrawal of your retirement annuities from South Africa. A lot of people who have left the country do not have any intention to return, and therefore their pension funds back home, they would most likely want to pull them out and reinvest them in their new country of residence. Now, in order to do that, previously, you would have to go through financial immigration in order to access your pension funds before the age of 55. Now this is gone. So how do you actually get your money out if you cannot use the formalized channel that used to exist? What the Treasury draft bill has come out to say is that you have to prove that you have been non-resident for 3 consecutive years, and then you will be able to pull out your pensions. Now, the 3 years does not have to be from the 1st of March 2021, or so they say. We're still waiting to see how this is going to be applied going forward, but I have seen that SARS has already established a memorandum, internal memorandum for their staff that has stated that if a person has not been non-resident for 3 years after the 1st of March 2021, that they would have to wait in those 3 years until 2024, essentially, to get their money out. However, there's nothing in the tax law that says anything about that at the moment. So we're still waiting to see how this is going to be applied. So what does this mean? Financial immigration is gone. You have let the SARS know that you have left the country. And now you have also done your tax return stating non-resident, non-resident, non-resident for the past 3 years. In theory, you should be able to pull out your pension and retirement annuities and bring them abroad. So now the big issue comes is if you did not declare your non-residency in your tax returns, you can request that these are backdated. You can request that these are corrected. And then you would have to declare your foreign income and say you're non-resident so that you do not get taxed. So I appreciate that I'm running through this very quickly. We just were running out of time here. Moving on. So upon ceasing to be a resident and withdrawing your retirement interest, this actually presented an issue for the South African Revenue Service, because it means that when a person has left the country and they've moved to a new country and they've become a tax resident in that country, and there's a double tax agreement, that when they pull out their pension fund interest, they would not have to pay the taxes on the withdrawal of that pension fund, because a double tax agreement would be enacted to basically cancel out the tax that is payable in South Africa by the taxes paid in the foreign country. So the budget speech, very cleverly this year, SARS has realized this and they are trying to fix this. So how have they decided to fix this? The 2021 budget proposes a new tax framework, and this imposes a deemed retirement fund withdrawal at the point that you cease to be resident. All that means is at the point that you have informed SARS you are non-resident, you are deemed to have withdrawn your pension or retirement fund. So this means that there's been a deemed disposal and therefore there is a tax liability to be had. However, when the individual ceases to be a South African tax resident, they would have been deemed to withdraw on the day before they cease to be residents. What this means is that there's a tax liability, but what it seems is that the person who has been deemed to withdraw, they do not have to pay the tax until they actually have received the capital from the retirement fund. So although there's no obligation for you to withdraw upon ceasing to be resident, you would have been deemed to have done so, but the tax liability would only be payable at the time at which you have received the actual capital. So this deemed disposal allows the South African Revenue Service to now receive the tax that's payable on the withdrawing of your retirement interest. This money would otherwise have been lost thanks to double tax agreements with your new country of residence once you had left. So that's one thing that was very interesting about the budget this year that they've now put into action. Now, the provisions of this are not very clear, so we are still waiting to see the actual proposed draft legislation as to how this would be applied. So all in due time, I'm sure we'll hear anything by June, perhaps latest August. They would put out more information regarding this. So this is something, that Jeff touched on. Essentially, Regulation 28 is the framework in which pension funds in South Africa they are managed in terms of what they can and cannot invest in to protect the interest of the pension holders. So essentially, it stops the investment teams of pension funds from going in and investing recklessly and losing people's life savings. Now, Regulation 28 has basically been slightly changed, and there's been amendments put forward that previously there was no direct definition of what is infrastructure and how much money is allowed to be invested in infrastructure. And so they've now said, why don't we include a definition for this? And this can then encourage investment into infrastructure. Now, a lot of people have seen the fear mongering, as what I would call it, of people saying that there will be forced conscription of assets. The government will come in and tell you, you have to invest in state-owned enterprise infrastructure projects, and your pension money is going to be down the drain. This is not necessarily the case at all. The decision to invest in what asset class, including infrastructure, that remains the decision of the trustees of the retirement funds. So they would always act in the interest of the people who have invested with them, and they do not have to invest X amount into infrastructure. There's no conscription here. But what they've actually done is there was, within the table of what you can invest in, you have equities, you have bonds, and then there would be a category that says hedge funds, private equity, and other assets not referred to in the schedule. Now, that's actually quite a wide range of assets that you can invest in. So all they have suggested is, rather than having a blanket term of hedge funds, private equity, and all other assets not referred to, why don't we just break it up into hedge funds, private equity, and then all other assets? This would allow pension funds to invest more specifically within different limits. Currently, the limit for this blanket asset allocation is 15%. So only 15% of a pension fund could be invested into hedge funds, private equity, or any other asset. What they have suggested for this year's budget is simply, why don't we decouple it and say, okay, private equity, you can have 10%. Hedge funds, you can have 10%. And any other assets not referred to can get 2.5%. So essentially, this is a way of encouraging the fund managers of the pension funds to invest into infrastructure projects. And they have imposed limits of how much they can invest into local South African infrastructure projects, as well as African projects abroad. Just because there's a limit, it doesn't mean they are forced to invest according to that limit, up to that limit. They can invest 5%, 10%, or however much they feel free, up to the prescribed limit. So my biggest takeaway from the budget this year is that the changes to Regulation 28 are very different from forced asset conscription. This is not what we're seeing at the moment. So there's no need to fear that your lifelong savings are going into the hands of people who are going to mismanage it and pump it into infrastructure projects because they are forced to. Completely different. So I know I flew through all of that, guys. Thank you very much for hanging on and listening to me. I know I rattled through quite quickly. We're going to have a bit of a question and answer session in the next slide. So please do feel free to pop your questions in the chat, put them across to me, and I'll try and answer them as directly as I can. Alternatively, if there's an answer that I can't give, I can come back to you with a more comprehensive answer. So please feel free to reach out to me for more information. Just waiting for my next little slide to catch up, sorry. You can reach me on LinkedIn. My name is Michael Booth. Very easy to find, Michael Booth, location Singapore, and you'll find me. There's a little South African flag next to my name. And then my email address is just listed here. So I look forward to hearing some of your questions and answers, and I hope you found this to be informative. Again, sorry for the haste in running through, but I'm aware that we've already gone over our allocated time.
Michael, awesome. Thank you very much. Yeah, no worries about going over the allocated time. We do have a few questions which have come through on the chat, which we would like to address. We are obviously very conscious that we are over time, and what we will do is, I think if we can just pose 1 or 2 questions to Jeff, and the other questions that we do have, we will try to get these answered for you afterwards, and we can post the answers to these on our webpage and on social media. Jeff, are you ready for your first question?
Mark, yes, please.
So one of the questions that came in is, will the focus on infrastructure capital raising or investment be focused more on SOEs, or will it be focused on public-private partnerships?
So I think there's it's a great question, and I think there's a good mix in there, right? So for example, the provision of student housing, right? That's not obviously an area in which government would lead in and of itself. If you think about sort of the digital rollout, that's not an area that government would necessarily lead by itself. If you think about in energy, for example, right? The 3 sort of headline projects you're looking right now around energy, of course, it's the small independent power producers. It's around sort of the emergency procurement of energy for electricity from the private sector today. And it's around the program where you're looking at sort of embedded generation. So we always think when it comes to something like energy that this is ESCOM led, but there are 3 very specific examples where it's very much the private sector in that space. I think broadly, right, the message from Treasury and the message from government here is this, as much as when they wake up in the morning, they probably first thought is, goodness, as government, we're going to do the following things. But there's just a recognition that the infrastructure backlog is enormous, that the fiscal space for government to lead here is small and dwindling. And so you're going to see more and more and more blended finance, PPPs, ways to get private sector involved.
Jeff, I guess as a follow-up to that, we've seen in the past that where the concept of public-private partnerships is not something that's new. I think historically it has been something that has been very difficult to get off the ground, just in terms of the time period that it actually takes to establish a public-private partnership. I mean, we've heard some of the stories of partnerships that have taken 7-8 years to actually put together. Do you think now that there seems to be a will from Treasury as well as a political will to get these going on a far more efficient basis? Because I would imagine that would be key to getting the stimulus into the economy.
Treasury themselves are making this example of projects that made perfect sense a number of years ago when they were first envisioned, but you get 5, 6, 7 years into the process, and sort of the commercial decision maybe makes less sense now than it is before. So I think there's a recognition that timelines need to be accelerated. There's a recognition that just more infrastructure needs to hit the ground now, right? But whether you've managed the the processes by which the right levers can be pulled at the right time to make a very lengthy process much shorter, I have less insight into that, I'm afraid, but certainly it's an area of focus. And when we think, for example, think in water and sanitization, right? So in water and sanitization, you have some huge projects, but you also have tons of much smaller ones. It's barely a municipality here in South Africa that doesn't need significant investments so it can provide appropriate water resources to its population. That government recognizes that is not going to be an area in which it is going to be able to provide all that is necessary in the time that it's needed in. So quite what breaks the logjam, I'm not sure, but the language from Treasury, the language from Public Works, the language from other areas is much more aggressive around getting broader participation now than it has been in memory.
I guess that's all we can ask for at this point in time, isn't it? Prem, a quick question for you. What are some of the risks that foreign investors into South Africa or Africa need to consider before investing, and how can these be mitigated?
Yeah, thanks. That's a really good question, Mark, because I think every foreign investor into Africa and specifically South Africa as well, needs to consider a number of factors. I think, the strong thing that South Africa has in its favor is certainly, the very strong institutions of government. And I think through all of the challenges over recent years, the institutions of government have largely remained intact. And where there were shortcomings, fortunately, we're in the position now that those shortcomings are being addressed. So in terms of the political risk, I think inherently, and given some of the structural challenges that South Africa has, there's still, in my view, a way for it to go before we reach a level of political maturity. But then again, when one looks at the US, one wonders if that is ever a possible reality in any market, right? But notwithstanding, I think ultimately it comes down to the returns. And if those returns make sense, then certainly the risks can be mitigated in some way or form, and certain risks will naturally just have to be accepted.
Yeah, I think that makes good sense, and it does boil down to a practical decision. Mitigate the risks as much as you possibly can, but it goes back to the old no risk, no reward.
Absolutely.
Jeff, have we got one more time for you? I know you're a bit pushed for time, so is it possible that we can throw one more question at you?
Absolutely, Mark.
Okay. So the question that came in was, how has South Africa's economy performed against the other African economies over the last 12 months?
You've had an incredibly wide range of performances across the continent. South Africa, we think, in 2020 shrunk about 7%, which would make it one of the more impacted economies globally. East African countries, Kenya, Uganda, Tanzania, were much less impacted in 2020 as a consequence of COVID than many others on the continent. That said, countries that had either sort of only one or two lines of business, maybe a narrow focus on commodities, particularly if it were energy commodities, or one or two areas of business, say you were an economy that was very heavily exposed to the tourism industry, then South Africa's minus 7% for 2020 would have felt quite good as compared to what's happening. So I think the performance there is mixed. What sets South Africa apart from the others is less about the impact in 2020 of COVID, but more the story of economic performance over the last decade. And there, it's very much not in South Africa's favor. South Africa has been struggling to grow before COVID, whereas many other countries, the vast majority of other countries on the continent, starting admittedly from much lower levels of economic development, much weaker levels of per capita income, or just wealth in their economies, have been growing much more rapidly. South Africa, highly industrialized, looks very much in many ways, very much like a first world economy, but has been struggling to crack the reforms necessary to see it start growing, not 1% plus minus or 2% in a good year, but growing the 3 or 4% year in and year out that South Africa has shown in the past it needs to grow if we're to generate meaningful employment. And in a country right now where the official figure for unemployment in South Africa is already just topped 30%, it's that year after year growth of 3 or 4% that must be the focus of government policy, of regulation, of private sector investment. Because unless we get there, say this budget isn't the thing that's going to hold South Africa back. It's just the inability to grow and provide a better future for all South Africans.
Yep. Thanks, Jeff. And I think that's a good place for us to leave it today, ladies and gentlemen. We're very conscious of the fact that we've gone 15 minutes over time, and we thank you for staying with us for this long. We will endeavor to have the rest of the questions answered. And as I mentioned earlier, we will post them on our social media pages. If you can go and check out our new website at www.sacham.sg, and have a look on Facebook and LinkedIn, and you will also be able to see a copy of this presentation on our YouTube channel, which should be up there shortly. Thank you very much for your time. We know that time is precious, especially at 6 p.m. in Singapore, and now heading into lunchtime in South Africa. So with that, thank you very much, and we look forward to seeing you at the next session.
That's all.
Thank you all. Thanks.
Thank you.